Welcome to the Winner's Playbook. Every winner needs a game plan, and this one's for you.
Welcome back to the Winner's Playbook. Josh here with my regular co-host Billy, and of course the federal budget was released last night, and we were up late into the hours of the evening looking at the federal budget, weren't we, Billy?
Yes, yeah. I didn't plan to. I thought I'll deal with this tomorrow morning, but I was just like, there was so much in it. And then, as you know, as an advisor, all you're thinking about is like strategy. Okay, what do we need to do? What's this mean? Well, so I got caught in that. And then I posted on, I put out a TikTok post at about 10:30, I think. And so I got a bit carried away. But
yeah, I seen that. A few people were quite riled up. I was riled up leading up to it, particularly for business owners. And it kind of, I guess the budget really delivered to expectations, not in a good way. No. It sort of delivered on most of what they've said. And it's a real punchy one. They've come out really swinging here and looking to make some big changes, which we're going to be talking about on today's podcast. But I think the key thing as well is although those things are being proposed, it doesn't necessarily mean they're all going to happen as well. They still do need to be passed.
Yeah, I mean, because they only, how long has it been since they started announcing or leaking that they were doing it? It's only a few weeks, I think.
For some of them, yeah.
So they've now set themselves up for all the backlash and the fight, negotiation, all that stuff.
Yeah.
They control Parliament, so they can probably legislate everything if they wanted to. And they've got a couple of years until the next election, but they're going to be up against some powerful lobbying and all that, and scare campaigns and all that sort of stuff. So it's going to be interesting. Yeah,
I didn't see the opposition's response. Did you see their response? Because it's quite funny always watching that, and they just shoot down, obviously, everything that they say. But I didn't stick around last night. I kind of seen it get delivered, and that was enough for me. I moved on to bed. Did you see the opposition?
No, I mean, the coalition is so weakened now. It's like if they just say, we'll repeal everything, this is bad, most people are just going to tune out because we all know they're going to say that.
Yeah.
They need to present another alternative, I think, other than just saying we'll say no to everything.
Yeah, but a lot of outrage. I think my social media, I'm scrolling through, it's just always something on there around property, negative gearing, etc. And I think that kind of might be where we start on, because really the key themes are around negative gearing, capital gains tax changes, and trusts. And then there's obviously a lot of other things that we'll talk through as well. But really the big key one, which was all of what they were proposing back in 2019 when Bill Shorten, he lost the election to Scott Morrison, wasn't it? And so they've basically put back in all of what they were looking at running on at that point in time, and that's why they lost the election. But if we start talking about the negative gearing one, because obviously property is why so many millionaires exist in Australia. It's not necessarily due to business and innovation. It's actually just due to we bought some properties some years ago and now we're worth more than $1 million. Like, how many Australians have just naturally done that and rode the wave of the property market? And Aussies have this real desire and lust for property, and we've spoken about it previously. It doesn't necessarily always go up in a straight line. And we're talking about in New Zealand and Canada, where property markets have actually been negatively affected. So if we talk about the negative gearing one, because that's one that hurts a lot of Aussies, because everyday mums and dads and people save up just with the hope sometimes to just get one investment property. They're trying to build some form of freedom in their life, and they're working in their job, and they work up to maybe buy an investment property or two if they're lucky. Like, the stats start dropping off dramatically when you look at property ownership, when you go from one or two and three properties. So really no one is immune from this. It doesn't matter your income bracket or whatever it may be. Like, negative gearing is they're looking at making these changes. So if we start there, Billy, what are the key takeaways around the negative gearing one?
Yeah, for briefly, what they're changing. So this one is very likely to be implemented quickly, I think, and possibly not repealed in the future. So what are they saying? They're saying if you buy a property anytime after 7:30 p.m., what was yesterday, 12th of May, 7:30 p.m, 12th of May, if you buy a property after that point in time, you do not get to negatively gear. Sorry, you get to negatively gear for 1 year, right, until the end of next financial year. After that, you are not allowed to negative gear. So any cash flow losses on that property, you can't use that as a tax deduction against your salary or other income. However, we were discussing that you can use those losses down the track when you sell the property. That could potentially reduce your capital gain, or it can reduce future income, positive income for the property.
Yeah.
So you do still get some benefit from the loss, but you won't get the negative gearing benefit, which gives you that tax saving, from day one when you buy a property.
Yeah.
So they're killing that off. With anyone who already owns a property, they still are able to negatively gear all the way into the future. Right, until they sell that property, or until it becomes positively geared.
Yeah.
So that is being fully grandfathered. New build properties are exempt from this, so you can still negatively gear there, because obviously they're saying we're trying to create more supply.
Mm-hmm.
And interestingly, the negative gearing is still allowed when you're buying shares, when you're buying commercial property, and when you're, even for residential property, if you're doing it through a self-managed fund, there's no changes there.
Yeah, a lot of when you look behind, read between the lines a lot among some of that, because you look at that headline of negative gearing, and a lot of people don't think of negative gearing in anything other than that of property.
Yeah.
But negative gearing is virtually just when you're borrowing to invest, and then you're basically making a loss on that asset. But like we were talking a bit earlier, it does make appealing some other strategies, which we already do use for clients. But if you're looking at leveraging or borrowing into residential property, or leveraging or borrowing, if you can, into the share market, or managed funds or ETFs, whatever it may be, you're still going to get the full tax deductibility of doing it via shares or commercial property, which is an interesting one, how they've done a carve out for that, which I think we've kind of gotten to when we were chatting before. Generally a lot more times in commercial property might have a positively geared scenario, so there's less tax revenue they could possibly raise, but still be some negatively geared scenarios there. But definitely puts on the radar more of the importance of considering other strategies, leveraging into the share market. And there are ways of doing that. But talking to the point of the why they're doing this is, I wasn't there the stats around there looking at, from making some of these changes, they're estimating an extra 75,000 people may own a home in future over their estimated timeline. But I think some of the bigger problems with it is it's because you can still negatively gear on new properties, but I'm not like a humongous fan of buying a brand new property, talk about it off the plan or a house and land package, because so much cost gets factored into that. And I think we were talking yesterday around this, and I've heard some developers talk about it. Sometimes when you're doing a development, 30 to 40 to 50% of some of the cost that is incurred from the developers is government fees and taxes and charges. And so it's like buying, I always think about it like buying a brand new car. When you look at buying a brand new car, in some situations, 20 to 30% of what you pay is just stamp duty and government fees, which is ridiculous. Particularly if you're looking at like a luxury car, you pay stamp duty and luxury car tax. But you're getting the same thing with a brand new property, because you're getting all of those fees thrown in. The developer still has to make money out of that. And then you might have, some buyers agents and things out there that get commissions from selling these
sales
things.
Commissions can be massive. I've heard of up to 50K,
like
lump sum. So you're paying for that, right? It's built into the
straight on the price. Yeah. And I unfortunately had seen it at a firm. Like when I first entered the industry, I had seen these guys doing exactly that. It was a terrible setup where the business owner basically had all the advisors, and I was at the business for a short period of time, and I never actually got to the point of actually giving advice, but they had the advisors basically recommending people set up self-managed super funds to go out and buy apartments, of which was owned by the owner of the business, and getting these 40, 50K commissions. So when you were buying the property, you were just negative equity straight away, and you're already negative from stamp duty as well. Like when you buy a property, you're paying stamp duty, which is virtually burning money down the drain. And then you throw on the fact that, say you buy a property for 800 grand, maybe the agent fees and all those commissions were $50,000 or $60,000, like you're already in a negative equity position. So, I don't know how I feel about these changes in terms of addressing like the broader issue of the housing supply. And we've spoken a bit on the last couple of podcasts around the amount of immigration we've had to Australia, which has put so much constraint on the housing sector, and there's not enough new homes. So, I don't know how this one will directly change that longer term. I think there's a broader conversation around the amount of people that are coming into Australia. For one, I'm not saying like close the borders or anything like that, like Trump, and nothing of sorts there. But you can only look at what's happened in the last couple of years, which has kind of led us into the position of where we are now. And then if you think about landlords as a part of all of this, the ones that are not going to be getting those negative geared benefits on new properties. moving forwards, what they consider doing. Well, rent, it's going to be an interesting one. And haven't they said something along the lines of I thought they said is it can be a $10 incremental, they're budgeting, it could be about $10 an extra a week in rent, they're estimating from these changes.
I mean, these estimates are nuts. I don't know what's going to happen.
Yeah.
My general feeling is property prices might stagnate or cool a bit because you've taken the heat out with all those people that want loading up on investment properties. So some people will get into their home because they won't be competing against so many investors when they go to an auction. Rents will probably go up because we got rising rates, rising inflation, and now there'll be less investors buying properties and renting them out. So you'll probably see some people get into the home, which is awesome. But on the other side, you'll see people who were only ever going to rent, so they can't afford to buy a home anyway, even if it's 10% cheaper or something, they still can't. They're probably going to cop some rent hikes. So, I won't solve the underlying issue. We all know that.
No.
We all know that. So.
I guess the key thing as well is I think a lot of people were negative gearing was just going to be abolished entirely on existing properties as well, but it's saying that it's going to be grandfathered. So, people listening doesn't mean that your existing properties means you should go run out and sell them. Selling property is always an expensive process, and transacting in property in general is an expensive process, particularly on the front end. You lose 5 to 7% in buying cost, stamp duty, and agent fees. And then when you're selling it, it's an investment property, then you've got capital gains tax as well. So you generally don't try to transact too often. But I guess if you're in a position where you've got a property, you got to look at what's happening over the next couple of years, because maybe there is some downwards pressure on pricing in certain markets, but it also wouldn't surprise me to see certain markets which continue to grow, and there's still going to be people out there buying properties, and particularly in this window, because what have we got? Was it 7:30? What was the date? May 27 or
7:30, May 12th last night.
We still got,
depending when this podcast comes out, it's as our budget night. We announced it.
So it's still got some time naturally there if you're going to be trying to buy a property, I suppose. So I'm sure there's probably people thinking of it from that perspective as well. Maybe there's a bit of opportunity if we're looking to buy a property anyway. Might be some favourable conditions from that perspective, you think?
Well, it'll lead us into our next topic, which is CGT.
Yeah.
So the main home is still CGT exempt.
Yep.
So if they're getting rid of negative gearing, so you think, okay, that's not as attractive anymore. What's still attractive? Buying a home and living in it.
Yeah.
Right. So there's still going to be those sorts of buyers. We push in to buy a home. If you've got the uber really wealthy people, they're generally doing this sort of activity through companies. It doesn't affect them.
Yeah.
So the conspiracy theory would be, well, not conspiracy theory. I guess the concern would be we start to see wealthier families and maybe even corporations decide, well, resi properties come off a bit. Maybe we'll just stick a bunch of those in a company and rent them all out.
Yeah.
It just creates distortions whenever they change tax rules like this. So I'm not sure if it'll solve the underlying problem that we've got.
No. And then, well, if we lead into that, so talking about the changes to CGT or the capital gains tax rules. So as of right now, if you own say a property or shares or an asset of sorts, you own it for over a 12-month period of time and you'll get a 50% discount on the gain. So say you buy a $500,000 investment property, say 10 years later it's worth $1 million. So you made $500,000 on that property. You would only be currently taxed right now on $250,000 of it, because your $500,000 gain gets cut in half by 50%, and then you're then taxed on the amount that is then left over. But in terms of what they're then proposing is going back to an old indexation method, and we've been playing around with some calculations around how that works. But even the poor old property owners that had the pre-1985 assets, they're even getting hit here in terms of no longer under the proposed rules will they be exempt from tax on the sale of those assets. They're even getting pulled into it.
Yeah. It would seem, I can't remember the last time I saw a client that still held an investment property from...
I've seen a couple.
Well, that's as old as me. I was born in 83.
I've seen a couple, yeah.
42-plus-year-old property that's still being rented out. You don't see it too often.
Yeah.
But yeah, the party's over there for anyone who's still sitting on those sorts of assets. They're hitting everyone with these CGT changes. So, the history is interesting. Before 85, there was no capital gains tax. If you made a profit on an asset, you didn't have to pay any tax on that.
Yeah.
Then they brought in indexation and full tax on the gain. And just to briefly explain indexation, essentially you've got your cost price, so the purchase price of the asset, when you go to sell it, they'll apply indexation to that cost base. So if you buy an asset for 500 grand and there's been 3% a year inflation over the period of time you've held it, they'll index that 500 grand. Let's say it comes out to now 600 grand after indexation, you'll then pay full tax on the profit over and above that.
Yeah.
So as you pointed out, we've run some numbers because in some cases, indexation is actually more favourable than the current regime of 50%. Yes, and so they're applying that, even if you already own assets, that indexation method will kick in July 2027.
Yeah.
So you'll have this complex equation where you've got a 50% discount for all the growth until 2027, and then you've got an indexation-based gain beyond that point. So accountants are going to be flat out, and valuers for that matter.
Yeah, bookkeeping and valuations, and it's going to be interesting because then when you're going to sell, you're kind of doing two tax breakdowns on one from pre that these rules coming in and the indexation method thereafter. And I suppose naturally, if I'm thinking people are going to be trying to, or they'll be trying to do in that scenario, getting those valuations done, because obviously valuations can vary quite a bit. So I'm just trying to think. I haven't thought through this other than now we're having a conversation around where you would want to try and get your valuation based upon how those rules play out. Because you could order a couple of valuations; they could differ quite a lot.
They could. I mean, there'll be all sorts of dodgy stuff going on.
Oh yeah,
because you could go and get three. I'm just thinking you could go and get 3 different valuations, set them aside, and hold on to it. And then when you sell the asset, go, okay, which valuation's going to give you the best outcome?
Here's the one.
Yeah, I know. It's it's going to be nuts trying to administer and police that for sure.
Yeah, and so when we looked at that as well, in some situations, because of the indexation, it really does depend upon what the inflation rate is year on year, because then that does amplify up the cost base. And we're playing around with some numbers before in terms of based on what you might be earning and the growth rates you get. There's some really good calculators that are already flying around online around some of this stuff, so you can play with it yourself. But it's an interesting one because in some situations when you look at that scenario of current rules, new rules, and selling, they're not overly too different in some situations, but factoring in depending on what the inflation rate is going to be on average over that period of time. So that one, all in all, I don't think as scary in some situations, but definitely situational, because then if you have some businesses and assets that are you're realizing quite large gains on, and if you think about, say, if a business owner or founder or entrepreneur that starts from zero, so cost base is zero, and exponential growth from there, and they're looking at liquidating or selling some investment down the line. It's not nice, and that's where I think I did a video on this yesterday as well. I was saying, I think I said something along the lines of the government does really need to be careful what they wish for here, because if they piss off all the business owners, I'm already seeing people doing it. They're talking about what are they going to do with their business and restructure it and potentially go offshore, because you look at, which I spoke about in my video, you look at other environments like Singapore. Singapore's a zero tax environment for business owners and for just individuals. You don't pay any capital gains tax whatsoever. So I would be sitting there and going, depending upon what the business is and the nature of it, or if you're starting out and you're going to start scaling a business, would you do it in Australia where it doesn't seem to be an incredibly pro-business friendly environment at this point in time? Or would you consider going off into another jurisdiction, maybe like Singapore, which is pro-business, a lot of money moving into those areas, and you don't have any tax on them whatsoever, and you could still probably operate your business, again, depending on what your business is, in an environment like that? Or do you stick in Australia where the government's constantly playing with the tax system? And I want to do a video on it soon. If you look at the amount of taxes you actually pay, we've spoken about this before, 47% top marginal rate, add GST on that, add the fuel excise, was it 50 cents in every litre that's in it. If you actually total those things up, in some situations you could be paying 60 to 70% of what you earn is virtually going towards some taxes and fees in some way, because you count rates and all those bits and pieces in there, stamp duty, car taxes, and so on. It starts to get quite nasty. So I think naturally, just from this, I already know some people that are just pissed off, and they would just look to, I think, move and restructure offshore, which I think then hurts the economy even more when you think about it, because it's all about stimulating the economy and jobs, but they're going to take that offshore.
I'm really surprised, and I hope they back down on this, that they've applied this new CGT method to business owners because what are they saying their goal is? We all know one of their goals is just raising more revenue so they can splash it around to win the next election.
Yeah.
But they're saying their goal is to address generational inequality. Like it's harder for the younger generations, it's easier for the older ones. But the younger generation, like we want them to run businesses and start businesses. So that's not going to help address the gap.
Yeah.
Right. The gap is let's say they're wealthy and they're over 60. They're not running and growing businesses for the most part.
Yeah.
They're sitting on old share portfolios and property assets.
Yeah.
So I don't know. I hope they're back down because there was some notes about, we'll consult with the business community and all this sort of stuff. So, well, fingers crossed for some changes, on that because we don't want to lose, some of our smartest, hardest working people to other countries. That's not good for any of us. So.
It's kind of what's been happening. So much innovation is.
It's already been happening, yeah. So this is only going to accelerate it.
Yeah. And so I think also what's interesting to the CGT tax changes bill is they're actually looking at putting in like a minimum threshold of tax to be paid on capital gains of 30%. And I was looking at some examples of how that would actually play out. So if you're in a lower tax bracket, and let's not get too strategic here, but the average tax rate, or to have an average tax rate of 30% in Australia, you need to be earning about $190,000 because you incrementally go through the various brackets, and then even once you hit 190, all of your money from that point is not taxed at the rate that you're in. It's only you incrementally go through those various tax brackets, which starts at the 16% and then goes up from there. So, average tax rate of 30% kicks in when you're paying when you're earning about $190,000. But if you then have some assets, and let's just say retirees, this is a clear example of the common strategy would be when you're a retiree, you build up all of your assets, your properties and shares and whatever it may be. You don't sell it whilst you're still working because then that's going to add more income to your taxable income. You're going to pay more tax. So the strategy always was wait till you get into retirement and then you start offloading those assets at that point in time, and you're going to pay much lower rate of tax. But what they're looking at bringing in here is just a minimum 30% tax on capital gains. So if you're earning no money, even though you'd be paying, or you would be paying a hell of a lot less tax under the current system, there's going to be a minimum threshold of 30% tax on capital gains, basically.
Yeah, it's another one. It's hard to see that hitting the wealthy again, because if your tax rate is below 30% on a gain, it means it wasn't a huge gain.
Yeah.
If you're selling $1 million property and it's got a $600,000 gain, you're going to be well above that 30 anyway. So it's actually, that's going to hit people selling lower value assets.
Yeah.
Like selling 100 grand worth of shares or something, paying 30%.
Yeah.
I'm not a big fan of that one either, to be honest. Interestingly, it says you've got an exception on this minimum tax rate if you're on any sort of Centrelink means tested benefit. So there's going to be some quirky strategies in there where you get a tiny part age pension and then you sell some assets and it saves you a bit of tax. And more work for advisors and accountants there.
Yeah, maybe some strategies around some annuities and things if you can get a little age pension and so on. If it's going to make a big difference from a tax perspective, some of those other strategies might actually come online. And if we're staying on the theme of like the minimum tax rate then, so we've gone from the CGT and then the capital gains, and then looking over to trust, which have been under the microscope for quite some time. They're looking at introducing a minimum tax rate on distributions through a trust that then go on to beneficiaries, which generally would be in a lower tax bracket. So the most common scenario there would be if, say, hubby or wife is involved in business or a shareholder, they get profits are accruing in a trading business. The business pays out a dividend and that goes to the trust, which owns the business. And then in the trust, you have discretion to basically send money wherever you like in simple terms. But commonly it would be like, okay, if hubby or wife's already working and earning over $190,000, you never send any extra money through to them. And that's where you would go to the spouse who's either on a lower income or earning less money, and you would get a tax advantage from doing that. But it looks like they're now, which is going to be interesting in how they actually play this one out, they're looking at just basically introducing a flat 30% minimum tax rates on distributions, which is just not nice.
Yeah, like from what I'm reading, they're saying the number of family trusts that have been created has exploded. And there's, what was it, like almost 1 million trusts or something. And the Labor government don't like this. They don't like that there's business owners or people with accumulated wealth that can direct their income to lower income individuals and pay low tax rates on part of that.
Yep.
They don't like that. So they're trying to shut it down with this policy. I think they also, like, there's a lot of businesses that operate through a trust structure. Like, they want to see them all go into companies, because once they've got a company, they've got to pay a salary, they've got to pay PAYG tax all through the journey. They've got to make super contributions and pay super contributions tax. They've got to pay payroll tax. So I think they're trying to bully everyone into using companies, anyone who's got a business. And they're trying to strip out, paying the distribution to the adult child and saving some tax that way and so on. That's what it looks like that they're trying to do there. What about bucket companies? I saw that.
Yeah,
in the limelight too.
Yeah. And again, if you look at who this is really impacting, it's like, I don't know the exact stats, but it would be majority business owners or people who have accumulated wealth through business, and then high net worth individuals. But like, pretty much every business owner client I have operates with a trust structure in there somewhere. And the strategy of using the bucket company is a very relevant one, because in simple terms, what I'm usually looking at with my clients is, hubby and wife is a scenario. Let's just say hubby's running the business, maybe wife's stay-at-home mum or whatever it may be, or works but earns like 60 grand, whatever the scenario may be. So all the excess profits and dividends that are coming through the traded entity hit their trust. Nothing more goes through to hubby at that point in time, because he's already earning $190,000, or you just cap what they're earning at $190,000, because then we know every dollar over 190 is then taxed at 47%. So we don't push any more there. The excess you would then get over to the spouse, the wife in this scenario, get her up to about 190 as well. Average tax rate is 30% for the two of them. And then any excess over and above that would then go down to another beneficiary of the trust, which is what we call a bucket company, but it's basically a separate entity set up, becomes a beneficiary. And then you would just put all excess money down into a bucket company. Generally, you're using that to then invest through the bucket company, but it's taxed at a maximum rate of 30%. But I think the big one here, which I don't know how they're going to get this one through and over the line, is, from the looks of everything they're saying, is there's going to be essentially double taxation on that strategy moving forwards. And what we mean by that is, generally what happens, or what would always be happening, is you generally don't pay dividend out of a business unless there are franking credits associated with it. So again, without getting too technical here, your trading entity would already be paying tax at generally 25%. So tax has already been paid on that profit. Then when you send that profit through your trust as a distribution and down to a beneficiary, in this scenario, it's the bucket company, because tax has already been paid at 25% on that money, you then only pay the difference between the 25% and what the marginal rate is of the individual or the company. And if it's a company in this scenario, it's 30%. So you only pay an additional, it's called top-up tax, say 5% in that scenario. But what it looks like they're wanting to do here is, that would still work if it's going through to individuals. So the franking credits can still follow through, but it's going to be taxed at the flat 30%, basically. But if it's then going through to a bucket company, the franking credits offset won't follow through with it. So you've already been taxed at the 25 or 30% if it's a large business in Australia, and then you want to siphon that money down to your bucket company. That's going to then pay a full 30% tax completely again, with no franking credit offsets. And only when the franking credit then comes in with it, that reduces how much total tax you then pay. And then again, you're paying that difference there. And from everything they're saying right now, it's going to be basically double taxation on bucket company distribution. So I'm pretty fired up, Billy.
I know. Yeah, they're trying to kill it off, but it's like, the main reason you would use a bucket company is, of course, you don't want to pay 47% tax on your company profits. That's crazy. So you send it, so you could just keep it as retained earnings, right? You can keep that money in your business, right? And not pay the extra tax. So you can still do that. But then you lose asset protection, because now you're accumulating profits within the trading company. So that money's not protected. You don't want to accumulate all this wealth alongside the operating business. So you send it through to another company and accumulate it there. So you've got a separate, protecting that wealth. That's all you're trying to do. It's not just a tax dodge. Like, you're still paying 30%. So it's a pretty nasty one, that one. I don't like it.
No,
I don't like it. And I'll tell you what's like, people are going to find ways around it so quickly.
100%.
You're going to be like, okay, we'll create loans, we'll create other intercompany
totally.
loans. Then they'll look offshore, and then like it's you know, I think 30% is a fair rate to pay.
Yeah, no, I
company
agree.
profits. So.
Yeah, I agree. And I know some clients have traded through a trading trust, which is not too common. But in that scenario, because in a trading trust, you can't actually retain any profit in the business because it's a trust. You have to distribute everything out year on year. So what they've done in their situation, some of these clients, is they have to distribute it out. But again, they don't go to themselves as individuals. They then have to send it all down to a bucket company, like all profit. So not only like the scenario that you were just saying is there is like, yeah, you can just retain some more profit in your business. Ideally, you wouldn't invest through your trading entity, but you could theoretically. But in this situation, people that have trading trusts, they generally push all of their profit down to a bucket company. And geez, like I can't imagine how that actually goes through, because if they're already paying 25% tax in the trading trust, basically, and then you're saying all of the profit distribution going down to the companies, they're going to be taxed again.
Yeah.
We'll be talking 50%.
Yeah, well, they're just trying to stop it from even being a thing.
Yeah, it's going to be really interesting to see how that one ultimately plays out. But then, yeah, when you still think about it, disregard the bucket company, 30% overall, when you consider like what we can pay in Australia, it's not that high of a tax rate. So I'm certainly not immune and afraid to paying a 30% tax rate. You obviously want to minimize your taxes best as you can, but paying 30% tax, it's not bad.
Especially if you're running a business, because you're also paying payroll tax and all the other bits and pieces as well.
Yeah.
So your real rate's higher than, so you're paying 30% on profit, but then you're paying a bunch of other taxes. You're hiring people, they're paying income tax. So anyway.
Yeah, well, and that's the general
I'm not
tax.
sure what I'm trying to get at here.
Yeah, well, the general sort of tax on your life though as well, of when you're operating and running in business, it's just, it definitely takes it out of you. And I think that's my key thing around all of these is really, like there doesn't really seem to be anything there for business owners. Like there's some things in there around, R&D and tax losses as well, when you're starting up your business, and also the 2-year carry forward or carry back.
Yeah, they've got, so we've complained about all the new taxes and extra taxes and all that stuff. All right, so who are the winners? Like what's in it? What's in it for the rest of us? Or what are the benefits here? A couple more losers. Fringe benefits tax on EVs. That's going to be watered down over time.
We've touched on that.
Private health insurance rebates are going to be reduced for anyone over 65 years old.
Yep.
So they're having a little crack at the wealthy retirees who can afford private health.
Yep.
That's the losers. Okay, who are the winners? Small business instant asset write-off of 20 grand for businesses with turnover below 10 million. So that's already in place, but they're extending it, right, or making it permanent.
Yeah.
Okay, that's a little win. The tax loss carryback, I think, is good. So this is businesses with turnover of less than $1 billion. Mm-hmm. So that's most businesses other than large corporates. Mm-hmm. Essentially, and this is partly to do with the Middle East war, I believe, is one of the triggers for them bringing this in. It's basically like if your business makes a loss this year, but last year it made a profit, you can bring that forward. You can offset the current year loss against last year's profit and essentially get a tax refund.
Yeah.
They're saying that'll be permanent, so that's a good thing. I think it allows you to sort of spread out the tax. You're still paying the same amount of tax ultimately, but you can spread it out a bit.
Yep.
Helps protect you in a bad year. I think they've got a carve out here for startups as well, where they can get tax refunds in the first 2 years of operation.
Yeah, it looks like they're expanding some of that. I haven't done too much into the detail, but I do know there are some sort of neat rules around like R&D and certain spend that you do as businesses, particularly when there's tech involved. So I want to dig a bit more into detail there, because it looks like they've put some more funding around.
They've put lots of money into R&D, but it's very highly targeted. Like it needs to be genuine. I can't remember what was the terminology. Yeah, it was to do with, it was quite complicated.
Yeah, it's not easy to get it.
So they're taking it away, I think, from a lot of businesses, and then they're targeting it more carefully.
Yeah.
On the business stuff, like it's like if they don't do a carve out for CGT though, all that stuff's a moot point, because all the entrepreneurs and stuff are just going to be, I don't want to give, build a business from nothing, sell it, and then give half the money to the government. They're not going to go for that. So
no. That's
so I am hopeful they'll pull back on that one a little bit.
Yeah, point quickly. I don't think we actually covered it off when we were talking about negative gearing as well, with the changes that are coming in. So say on those new properties still exist, but then on not existing properties, older dwellings that you purchase, so it's not a new property, negative gearing won't apply, so you can't take that loss and do anything with it. But I don't think we mentioned the loss is carrying forward every single year. So that loss, say it's 10 or 15 grand on a property, then when it comes time to, if the property does start to go positively geared, you can offset that income. Or when you eventually get to the point of possibly selling the property, that accumulated loss over those years can offset the gain. So I don't recall, I don't think we actually mentioned that point when we were talking.
We mentioned it briefly, but
it's an important point to note though.
Yeah, you don't lose the loss altogether, but it's going to be a long time until you get anything out of it.
Yeah, exactly right.
It's net gearing you get straight away, and you can offset it against salary, which is often at a higher tax rate. So.
Yeah, it's carrying forward. But what about, there's a couple of little cash grabs in there.
Okay, so look, what's the whole point of this? We're addressing intergenerational fairness, right? So we've spoken about all the people that are getting hit, business owners, wealthier people using trusts, people doing investment properties.
Yep.
All right, so everyone who's not in that category, what can you look forward to? You get $250 a year.
What's that?
Starting in 2 years. Starting in 2 years' time.
Coffee every week.
You get $250 a year. They're reducing the marginal tax rate that applies for income between, $18,000 and $45,000.
Yep.
Marginal tax rate is going from 16% down to 15%, and then the year after that down to 14%. So the total value of that is $536 a year. So in 2 years' time, if you add it all together, you're going to get to keep $786 a year of your salary. What does that mean? Like if you're earning 80 grand a year, right, a pretty common sort of salary range, let's say 80 grand a year is your salary, you'll get to keep an extra 1% of your money each year. If you're a high income earner, let's say you're earning 200 grand, you'll get to keep 0.4% of your salary. So we've got a huge amount of changes, a huge amount of complexity, especially the trust and the CGT stuff.
Yeah.
And it'll give you, for workers, you'll get to keep 0.4 to 1% of your salary.
They're calling that
giving it up to the tax man. So that's going to close the gap and make it all fair and even for everybody.
Well, they're calling it the WATO. That's the WATO. That's the WATO. Because you remember a couple of years ago we had LMITO, which was a low and middle income tax offset. So that was the $1,000 or $1,500 that everyone was kicking and screaming because it got brought in due to COVID. Yeah. And then they removed it and everyone was kicking and screaming. But they've called this one WATO, which is a working Australian tax offset of $250. So get around that. And then there's also the instant asset tax deduction for work-related expenses. So my understanding there is, I think that's kind of like LMITO in a way, but I don't think there is an actual income bracket restriction on it, which is what LMITO was then for. And so for this one, it's basically a tax deduction of $1,000 for work-related expenses, but you don't need to provide receipts.
Yeah, so most people would not want to do that because if you've got receipts of more than $1,000 for work-related costs, you're way better off doing that.
Exactly right.
So it's actually like a few people are going to get jibbed by that because they're going to go, sweet, I know I can just get my $1,000 deduction and not do any work for it. Well, if you did a little bit of work for it or saw an accountant, you'd probably be able to find a lot more than $1,000.
Yeah, 100%.
Yeah,
that's the value of having a good accountant.
No benefit in that.
No. Yeah. Now, before we get to closing out of what the, what are some of the winners? Because of course, superannuation hasn't been touched, which is great, but it has been touched probably enough up until this point. So I'm just trying to cover off and make sure if there's any other key points that we haven't missed before we sort of summarize. Have we missed anything, Billy? I can't think of anything.
I think we've covered all the main things, but I think like with the trusts and the companies and all that stuff, nothing's going to happen for 2 or 3 years.
Yeah.
So these things may not happen, or they might be watered down or changed or scrapped altogether.
Yeah. So
we don't need to rush out and restructure everything and panic because they've only just announced it. There's going to be huge pushback, consultation, whatever that looks like, potentially watering down. They've got to win another election in a couple of years' time.
Yeah.
So we don't worry too much about all that. That's a couple of years off. And that gets us to what has not been touched and what is still some great ways to build wealth and structures to use.
Yeah. Well, superannuation, obviously a big one. So that's still there and is appealing. So there's no changes there. All this talk on negative gearing and minimum tax rates and things has no impact on superannuation whatsoever. So that is a win. And then it definitely is bringing on the radar and making, if this all then goes through, investment bonds are going to get more on the radar, particularly again for high income earners, but also everyday Aussies as well. A lot of everyday Aussies will use investment bonds because they already do have a cap tax rate of 30%. but you can sell them entirely tax-free after 10 years. So they're quite appealing. I think will get more appealing to high net worth individuals or kind of anyone above a 30% tax rate. Investment bonds are going to be on the radar, and yes, superannuation is still just as appealing as it was, even with Division 296 coming in, but that only affects a real small margin of people in Australia.
Yeah, that's what's wild is it took them 3 years to get that legislation through about super balances above 3 million.
Watered down a lot.
And now what they've announced last night is like way more wide-reaching and dramatic than the super change. So I'm surprised they've gone from being piss weak on super to now trying to overhaul the whole system.
Well, I think, is this a negotiation? Like we've spoken about this a few times, is this them coming out swinging and they're going to really know that they're going to come out heavy with a big, kind of like an offer, but really they know back where their fallback is, and that's probably where they want to land around some of this stuff. There's definitely going to be changes, we know that. Some will go through for sure, but maybe they're coming out swinging here to get everyone riled up and be like, no, it's all right. Now we'll water it back to this is what it's going to be. They've anchored us to this point, which is like sales 101. You anchor someone to a higher point and then you pull them back. That's what the government's possibly done here. We'll wait and see, but the skeptic in me thinks that way.
Yeah, for sure. I mean, it depends the pushback they get. In terms of like support for the actual legislation, probably the Greens and the left-leaning groups will support it eventually. They might say it doesn't go far enough and have a shit fight about that. That happens sometimes. And then they're going to see what it does to their what the voters think of it, because they still want to win the next election. So
and some final spoken thoughts as well.
Bridge.
Talking a bit about for business owners. All of this, there can't be any knee-jerk reactions because none of it's gone through. It's going to be a phased approach in terms of how it all plays out. There are some provisions in there for business owners as well, as if this all does come into play, then they're giving some, I think, 2 or 3 years rollover reliefs where you'll be able to sort of restructure things within your business. So that is a positive. If a negative if they put through all these things, but they are giving you the means to be able to possibly restructure your business and avoid paying tax in certain ways as well. So there's definitely going to be time. I guess from me, my final points would be just you really need to be getting good advice around this sort of stuff. And we'll see how all the dust settles here, but don't need to be rushing out and doing anything at this point in time because it still does need to all get passed through. But best bet as soon as it does, we'll be in contact with all of our clients and informing them on what they should be doing with their life and their strategies. And I don't think we need to harp on about it enough. Like I don't think it actually truly addresses the core issues around housing supply and what's going on in the housing market. But any closing thoughts on your end?
Oh, look, the only thing I would action immediately is just don't go buy an investment property, because you might not get any net gearing. It completely changes the equation.
Yeah.
And that's supposed to come in immediately. So that's the only thing I would not do. Aside from that, everything else still got time to see how that all plays out.
Yeah, property definitely could be a bit less appealing if that negative gearing stuff really does happen. And because we've spoken about it recently around, the true rate of return on and your holding costs, if they're going up, there's going to be naturally a hell of a lot less people buying properties if they can't negatively gear, because some people do really rely upon the loss year to year and can't wait until the property is sold to get any sort of benefit from a tax point of view.
Yeah, so if you're keen to do it, you might get into the commercial property space because I haven't touched that.
Yeah.
At this stage, you can still do SMSF, some resi property. There's no changes there. So if you're really keen, I'll look at those options.
Yeah.
That's really the only thing I think that you immediately need to back off on.
Yeah. And if always in doubt, obviously speak to, your advisor, accountant, whoever's in your dream team, so to speak. But no, I think it's been a good podcast, Billy. We'll finish it up there. And anyone's got any sort of feedback or topics you want us to cover off, please feel free to drop them through in the comments, and hope you got value out of today. And we'll finish there, Billy.
Thanks, Josh.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal